Let's talk about Chapter 20 exercises. I have the screen open to the Chapter 20 computational exercises in your book. They're on page 31 of Chapter 20. If you want to take a look there, you certainly can. So Chapter 20 is about trusts and estates. So they kind of go hand in hand. I mean, they're taxed fairly similarly, so there's lots in the chapter about both. Make sure you understand some of the key terms for both. When it comes to a trust, there are some key terms at the beginning of the chapter, and same thing with estate. So just make sure you've got those down. That will help you with some of the homework, especially the quiz and the test that you'll get for Chapter 20. So on the screen here, you can see our homework problem for Chapter 14. Compute the federal income tax liability for the Valerio Trust. The entity reports the following transactions for the 2018 year. The trust accumulates all accounting income for the year. And then, so it's just building up its income, essentially, and then eventually it'll get paid out. So you can see here what all the items are: operating income from a business, dividend income, interest income, which is obviously from San Antonio City Bonds, so that would be interest-free, fiduciary fees, deductible portion, and the net rental losses, which is a passive activity. And so let's go ahead then and figure out what the tax would be on that. Now, generally, with a trust, whoever receives the income would pay the tax, but you can see here the key is that this one's being accumulated here, so it's going to stay within the trust, meaning we'll have to pay tax for it out of the trust. Okay, so it's just really a matter of just going through and identifying what the items are that need to be taxed. The first one is the operating income of a business of $500,000. So I just put in OI for operating income. And then what's deductible for a passive loss, and which happens to be nothing. So the amount that they mention here, let's see, the net rental passive loss is right there. Can't take that, so we're not going to do that. So that's just a 0. And you get a personal exemption, which is not very much, but we might as well plug it in there. Okay, it's only $100, but we'll put that in, minus 100, and then deductible fees. And the fees right here are $15,000. Okay, so then we just add those up, and we get $484,900. And then from there, it's just a matter of plugging in our tax. And so it's a matter of going to the personal tax tables and just keeping in mind that trusts typically pay at the highest level. Okay, so if you looked up the personal tax table and you found the $484,900, that puts us at a tax of 3011.5 plus 0.37, 37%, times the difference between the 484.9 and 12.5. So 12.5 is the exemption that you're allowed. So we do that difference, and that gets me, let me fix that here. So so it's the sum of the two is the tax. So my tax is $177,799.50. Just watch when you enter something like that in the Cengage. It probably just wants you to do the whole dollar and not down to the penny. So I would guess it went $177,800. And then you have tax on dividend income. We haven't talked about that yet. Right here, $30,000 dividend income, and that will be at the highest rate. Okay, so that's my dividend income. The tax will be 20%. Oops, let me do that right. So 30,000 times the 0.2, and I get 6,000. Okay, and then we have to pay an additional tax on undistributed net investment income, and pay an extra tax on that, which is 3.8%. So the next thing we do is we take the 30,000, okay, right here, the same 30,000, and that's 6,000. So that tax here, let's just say, let's put that right here so it lines up with this number here. Okay, so I'm paying 177.8 plus 6,000 plus I'm going to pay a tax of that 30,000 again, minus an exemption of 12.5, and then I'm going to tax that at 0.038%. Okay, 0.038. So that's basically a tax on undistributed net investment income. So I'm going to take the 17.5 times the 0.038, and I get 665. So my tax is the sum of these three items right here, which is 184,465. Probably, again, you'd want to enter that as a whole dollar in Cengage when it asks you. Okay, so basically it's because this trust kept all the income. It still has to pay tax, and you typically pay at the highest rate. So we paid the highest rate for dividends, 20%. We paid at the highest rate for ordinary income, and we had to pay that penalty tax of 0.038. Okay, so all those come into play. So the tax on this is 184,465. Okay, I'm skipping 15, and then go down to 16. It says for 2018, the Guess Trust retains all of its income, which includes only 100,000 net investment income and 40,000 profits from an active business operation. Guess incurs an additional tax on net investment income of, and they give us some options there to choose from, and the answer is letter C, 3325. And so what we do is we take the 100,000. If you remember right, the 100,000 came from the net investment income. So I take that 100,000, and then I subtract from that the exemption for the untaxed amount of 12.5, and so the net is what's taxable at that extra rate, that 0.038 net investment income tax. So let me give that an extra decimal so you can see at 0.038. So the answer then is 87.5 times the 0.038. I get 3325, and that was the answer. Letter C, 3325. Okay, question 17. The Biltmore Trust is a simple trust. Crawford is its sole beneficiary. In the current year, the trust earns $3,200 in taxable income, in taxable interest, I should say, and $8,000 in tax-exempt interest. In addition, the trust recognizes $2,500 long-term gain. The trustee assesses a legal fee of $1,800 for the year. Compute trust accounting income, where the trust agreement allocates fees and capital gains to corpus. And then letter B is same as A, except that the fees are allocated to income. So this is question 17, letter A. So let's go ahead then, and if the trust allows in the trust agreement allocates fees and capital gains to corpus, trust accounting income is 11.2, and so I'll show you what that is. So down here, it's the 3,200 plus the 8. Okay, so in this example, if trust agreement allocates fees and capital gains to corpus, trust accounting income is 11.2. They're 32 plus the 8, which is 11.2. For letter B, now the fees are allocated to income. Okay, now I get the 11.2, but now I can subtract the fees, the trustee fees that are assessed. So now the answer to B is 11.2 minus 1,800, which equals 9,400. So a subtle difference, but an important one. Question 18, Hosted Trust reports gross rent income of $72,000, expenses attributable to the rents of $55,000, and tax-exempt interest from state bonds of $18,000. Under the trust agreement, the trustee is to pay 20% of annual trust accounting income to the American Red Cross, a qualifying charitable organization. So letter A, calculate what their charitable contribution deduction is. So the first thing is to compute what is their accounting income. Okay, so take a look at the numbers. So rent income of 72. minus the expenses of 55 plus exempt interest of 18. So 72 minus 55 plus 18. We'll just go ahead and type those in. So minus 72, I'm sorry, plus 72. Just simply 72 minus 55 plus 18. Add those up. We get 35. Okay. And so then we all know, going back to the question, the trust pays 20% of annual trust accounting income to the Red Cross. So 20% is what's paid. So 35 times 0.2 is 7,000. So 7,000 then goes to the Red Cross. Now, however, the deduction is not that high because they had some exempt income. So we'll take the 72,000 right here, and 72,000 is the rent income, and then they had 18,000 worth of exempt interest income. So we're going to calculate what's allowed for them to deduct, and we're going to take 72 and then just take that and divide it by the sum of 72 plus 18. Okay, so 72 is the rental income, 18,000 is the exempt income. So I take 72 divided by the 90, the total of both incomes, which is 80%, and then I multiply that by the 7,000. Okay, so I'm going to put in my 7,000 here, and so 80% of 7,000 is 5,600. So what they're allowed to deduct is 5,600. They can make a deduction of 7,000. They can only deduct 5,600 of the contribution, though. Okay, that leads us to a couple of more. So that was the computational exercises, but we'll do a couple more. I'm going to skip down to question 21 is the next one. And you can see here, it says, complete the chart below, indicate Calvet Trust entity accounting income for each of the alternatives. For this purpose, use the following information. So interest income taxable, interest income exempt, interest income tax exempt but AMT preference, long-term capital gain, and then a fee. And so the first one is fees and capital gains allocable to the corpus. And so with this one, what we can include is the first three, the 300, the 30, and the 20. So it would be 350 would be the answer. For the second one, capital gains allocable to corpus, 1/2 of fees are allocable to income. So it's kind of the same thing. It's the 300 plus the 30 plus the 20 for 350, but then I subtract half of the trustee fee of 10,000. So then I back off half of 10,000, which is 5,000. So I get 345. So it's 350 minus 5 for 345. The third one is capital gains allocable to income, silent concerning allocation of fees. This one then basically says most state laws allocate fees 1/2 to corpus, 1/2 to income, unless the controlling interest documents tell us otherwise. So without it being stated, we'll assume it's 1/2 and 1/2 because most states allocate it that way. So then it's the 300 plus the 30 plus the 20 plus the 40. So now it's all 4 income items minus half of the fee. So it's 385. So the sum of the first 4 is 390. And we back off 5 to get down to 385. Okay, and that is it. So take a look then at 22, and 22 is another chart. It's just more concept based. 22 says, complete the following chart, indicate the comparative attributes of the typical trust and estate by answering yes, no, or explain the differences between entities where appropriate. So separate income tax entity, and then the question is, mostly the answers are yes or no. The answer here is yes and yes to both. Okay, so yes and yes. Controlling document. The controlling document for an estate is a will. And then the controlling document for a trust is the trust instrument. So a will and a trust instrument. The third one can have both income and remainder beneficiaries. The answer for both is yes. Yes and yes. The fourth one, excuse me, computes entity income before determining entity taxable income. The answer again is yes and yes. Termination date is determinable from controlling document. The answer is no. Termination occurs when the estate's activities are completed. This might be a substantial period of time, potentially. Trust is a yes, although such date might be contingent upon other events such as the grantor's death or the beneficiary's graduation from school or age or completion of some contractual duty. And the last one, document identifies both income and remainder beneficiaries. It's no and yes. Question 23 is Roberto is one of the income beneficiaries of the Carol Lamons estate. This year, as directed by the will, Roberto received all the sales commissions that were earned and payable to Carol cash basis at her death, as well as one of the 3 remaining installment payments. Compute Roberto's gross income attributable to Carol's activities for the current year, given the following financial data. So sales commissions received, ordinary gain of 60 on installment sale, first of 3 payments received this year, 20,000. So really, really simple. It's simply 60,000, the 40 plus the 20. Okay, so it's 60,000, 40 plus the 20. Question 24. Sanchez incurred the following items: business income of 80, tax-exempt interest of 40, payment to charity from gross income of 20, paid on 3/1 of 19. Complete the following chart indicating charitable contribution deductions available under various scenarios. The first one is Sanchez is a cash basis individual. The answer is 2018 deductions. The answer would be nothing because it was paid in 19. So as an individual, Sanchez cannot take advantage of the deduction until it's paid, which would be in 19. So in 18, that would be a 0. The second one, Sanchez is an accrual basis corporation. Now the answer is 80,000, which is 10% of taxable income. With 2.5-month grace period, no loss of deduction due to exempt income. Okay, so 10%, which is 88,000, and you've got until 2.5 months. So being paid on March 1 fits that. So 2.5 months is March 15th, so he's well within that. The last one, Sanchez, is a trust. Now the answer is a little bit different. It's 13,333. Limited to 80 of 120. So 80 plus 40 is 120. Okay, and so he can take 80 divided by 120, that ratio, and use that. So it's 80 divided by 120 times 20. So 80 divided by 120 times 20 is 13,333. And that's what's allowed. Okay, so that's it. I think you'll find they're fairly straightforward questions for this chapter. If you have any questions, by all means, just let me know. Thanks.